This is the Real Estate Investing 365 podcast, your go-to source for real estate investing strategies so you can start living the life you want and get where you want to go. With your host, Justin Hanna.
Hey everybody, welcome back. Another episode of Real Estate Investing 365. Today I got Lucas Miller with me. He's owner and founder of Bannock Capital, and he is located in Denver, Colorado. He started out in the small single family and small multifamily rental space, moved into syndication, and he's here to show us his ways. What's up, Lucas? How's it going?
Dude, I am doing great. Thanks so much for the opportunity to jump on and talk with you and talk real estate.
Yeah, for sure. Absolutely. Yeah. The syndication space is a huge, it's like exploding. It's been around for so long, but
Yeah.
now I think with social media and every podcast and everything, it's a lot of people is doing it. And it's honestly a great way, both as an operator and as an investor, to get into real estate investing that people might not have thought about in the past.
Yeah, it's fairly, of course, pooling money to buy real estate has been around forever, right? But the idea of being able to open up some of these private offerings is something that's sort of new. But yeah, like you said, it's the hot new thing right now, and for good reason, right? It's a way to offer investors the opportunity to invest in these wonderful deals, but on a totally passive scale, right? So
Yeah.
it's really cool.
Cool. Right on. Well, before we get into everything that you're doing right now, why don't you kind of give us a little background of where you live, where you came from, how you got started in real estate, and then we'll move on to like your current operations.
Yeah. So my journey to real estate investing was, of course, it started with Rich Dad Poor Dad, right? Like everybody.
Yeah.
But really, it evolved from there in different ways. And so, what I mean by that is, I didn't typically like take the traditional route and go out and buy a property the next day. I tried to kind of craft my career and what I was doing around real estate and try and slowly transition into that because I was scared, right? I had a ton of fear. And so I, of course, read the book and started working. So I was working on politics at the time. I was working in Washington, D.C. And before you judge me too much, I moved back to Colorado, which is where I grew up. So I'm in Denver, or South Denver. And I actually became a lobbyist. So I became even more hated by people. So, but before you judge me even further, I was actually a lobbyist for some big multifamily owners and managers, basically. And I was essentially lobbying on behalf of their interests and keeping landlord tenant laws friendly, keeping regulatory burden costs down. So when most landlords hear that, they're like, okay, you get a pass, I guess you're okay. But
Yeah. Well, I'm probably like most people. I don't even know. You hear that word, but real quick, what even do you do as a lobbyist?
yeah. Well, for some of your listeners might watch House of Cards or something, and a lot of it is similar, but a lot of it's different. So basically, as a lobbyist, my job is to protect the interest of whoever's paying me. So when you're talking about multifamily owners and developers, they pay me to essentially run interference with the government if they're trying to tax them unnecessarily, or a big thing of what I did was zoning issues. So going in with developers and figuring out zoning problems and how to fix them. A lot of what I did was landlord tenant laws. Of course, there's some very progressive members of Congress here in Colorado that want to see the landlord tenant laws change so it's very tenant friendly, moving us closer to where you're from in California or New York or Seattle.
Horrible.
And less of the landlord friendliness. And so a lot of what I did was fight that stuff.
Okay.
So, and hand out checks. Like that's
Yeah.
the dirty part of it.
Hey man, that's okay. Whatever pays the bills.
Yeah.
So anyway, sorry I interrupted you. So you were doing that.
No, it's fine.
You moved back to Denver area and you were kind of doing the lobbyist thing and then continue on.
So fast forward to lobbying, I was like, oh, I crafted my career. So I got into multifamily and real estate investing. And I'm able to get in the door with, Denver's biggest and best lobbyists, or excuse me, not lobbyists, but developers and owners of multifamily. And so I got to add value to them while still, learning from them. Right. So I met with some folks, and really one of them really just sparked this interest. He was a young guy like me, and he was, just crushing it in the syndication game. And I finally just asked him, like, hey, how are you doing this? And we went to lunch together, we talked a little bit about it, and that was enough to like spark that interest in me. And a couple years later, quit my job and started doing it full time.
Yeah, that's awesome. So to get some context on it, what year was it around that you kind of read Rich Dad Poor Dad and you first got
Oh
your
man,
wheels turning?
probably about 2012, I would say
2012.
2012 or 2013.
Okay. And then when you met this guy that was kind of younger, what year was that?
2015.
Okay, cool. Because you're not an old guy now, so you
No.
must have been younger then. How old are you at this time?
31 right now.
Okay, that's right.
Yeah. So, and when I had met that guy, that really sparked the syndication bug with me. Um, of course, I had been investing in small, residential stuff at the time, mostly small rentals and doing flips. And, I was just really bummed out and really frustrated with how, I guess, amateur it felt. And I don't mean that as a pejorative to people that are doing that. That's, it just didn't really fit my investment style. I am a huge fan of building businesses like that. I love the idea of building a business. And so syndication is much more like running and building a business than it is like investing in real estate. So it just fit me a little better. And once I found that, it was
Fit the
everything
bill.
to me.
Yeah,
Yeah.
yeah, it
So
worked out much better. So, can we dive in a little bit to your, single family or your small rental portfolio that you had before you got into syndication?
yeah, yeah. So the first ever building that I bought was in 2014. It was a duplex, and it was in Denver, and it was on Bannock Street, which that's why I named my company Bannock Capital. It was just like an homage to that first property.
Yeah, I was
But
wondering
it
because
was,
I was like Lucas Miller and Bannock
yeah,
Capital.
yeah, exactly. Um, so it was a great property. Me and my wife actually house hacked that, and so we lived in the upper half while we were renovating it. Rented out the bottom half. We paid $12 a month um, towards our living expenses, which was awesome. We were almost 100% covered, but we didn't quite get there. And then eventually moved out, rented it, and just kind of cash flowed that while we were doing flips. And then we bought some other small quads as a portfolio, ran those, and then really decided to jump into the syndication game full bore and just kind of sold everything. I burned the bridges, I sold everything, and used that money to just start the company and start passively investing too.
Okay, so those properties that you had, were they all centered around Denver? Or did you kind of branch out into other areas?
Yeah, no. So we tried buying out of state, and it was okay, but it was hard. And we can get into a little bit of why I love big multifamily so much. And a huge reason of that is because of management companies. Usually, if anybody has a management company and a bad experience about it, you know exactly what I'm talking about. It it it's just hard to find professional property managers on a small scale.
Hmm.
Usually they're like realtors with a side hustle of a property management company, or they have thousands of units, and so they run it in like churn and burn, and there's no personal touch. But with large multifamily, which is what I love, it's run much more like a business. And so you're able to, they're able to actually make money on your property, right? They're not making like $100 a month. They're making hundreds of thousands of dollars a year on your property. So they treat it very well. They treat it like a business. We expect a lot out of them. So I love that idea. But yeah, we tried the out of state game, and it just didn't work out.
Yeah. Okay, so you had your properties and you realized, yeah, this isn't really for me. I kind of want to go in bigger scale and I want to see how to expand this. And obviously, the roadblock people run into to just buying properties on their own or getting into larger properties on their own is, for one, you need capital, right? You need a lot of
Right.
money to close a big deal. And for two, especially when you're new, you need, a net worth requirement. The bank is going to require your net worth most of the time to be at least that of the property that you want to buy, right? Is that
Mm-hmm.
is that right?
Yep. Yep. You're dead
So
on.
yeah, so that's a huge barrier to entry, right? So if you don't know, um, I guess if you don't know a lot of people, is probably that's an issue on both sides, buying your own property and raising capital. But
Yeah.
um, that's why people kind of then go towards a syndication model. So, um, how did you kind of get started into it? I know you knew that guy that you said
Mm-hmm.
you met in Denver. Did you go to him for advice, or did you end up getting a mentor program, or what was your path to success with that?
Yeah, so he really just sparked that interest in me. He didn't have a whole lot to teach or anything. Of course, I didn't really ask a whole lot. I'm sure he would have if I would have asked, but now it's at the point where we're kind of competing against each other, so we don't really talk anymore.
Yeah.
It's kind of a little caveat there, but uh, yeah. So I found a mentor, and it was really one of those things that uh, you struggle with it, right? You go back and forth, and I ended up spending most of 2018 trying to do this on my own, really spinning my wheels and not knowing what I was doing, and frankly, wasting a whole bunch of time. And so then I started talking to my mentor, and his name's Mark, but we talked a long time about why that is and how he could basically cut that learning curve off. And it just makes so much sense. I know, like, especially in the bigger pockets realm, paying for education is like, the ultimate insult, right? You should never have to pay for anything, right? Everything should be free. But when you get into like large commercial multifamily, it's different. There's whole lots of things you need to understand, and really the only way you can do that is through experience. And so you can find those people on your own, which I tried to do. I really tried to like find that free education, but it's so hard. And or you can just suck it up, pay someone for their time, and learn from them.
Yeah, no, I'm in the camp. I've always been conflicted on the fact of, paying for, um, a mentorship program or these training programs. But I think I do believe that if you want to accelerate your growth, get to where you want to go quicker, you need to get somebody like a mentor that can help you
Hmm.
get there, that's done it before. And these people that you're getting, they're obviously highly successful in their own right. So most of the time, unless you're their nephew or their son or something, you know what I mean? They don't have the time to like spend on everybody just for free. Like their
Oh
time is
yeah.
worth something because they've got their teeth kicked in however many times. So their knowledge is worth something. So I definitely
Yeah.
am in the boat of paying for the good mentorship. Was it Mark Kinney?
Yeah.
Is
Yeah.
that who it
Mark
was?
Kenny. We
Okay.
think multifamily, and his track record is just phenomenal. I mean, I think we ended up, me and the group combined purchased, I think 25 or 2,800 units last year
Oh
in
wow.
2019 alone. So that puts him well over, 7,000 units, probably closer to 8,000 units total. So when you look at that, it's like, it was a no brainer for me. I'm not
Hmm.
saying it's right for everyone. And I want to make that very clear. Like, I'm not here to pitch any sort of sales program. It worked for me.
Yeah.
But your mileage may vary.
No, for sure. And it's funny, I didn't even know that you did this. This is just coincidence. I had just talked to him actually today, not the day the
Oh,
podcast
really?
comes out, but today we're interviewing. This afternoon I talked to him because I'm going to be interviewing him in a couple of
That's
days.
awesome.
So, um, what
Yeah.
a strange coincidence there that is.
Yeah. And the best part about Mark, and I don't want to get stuck on here, but he's just the nicest guy, like just so down to earth, so genuine. He has, anytime you're in Dallas, he'll invite you over to his house. Like, anyway, but so that was really important to me, especially because these syndication deals, they're not, you're not buying this property in a vacuum. You have to partner with people like you were talking about. So you really want to choose the people that you're talking with and you're partnering with. So, you want to take your time on that, and you really want to be involved with the right people for 5-10 years, probably, for
Mm-hmm.
some of these properties to cycle. So that's critical to me.
So do you end up partnering with your mentor or with Mark or with somebody in his group?
Yep. Yep. All of
Okay.
the above. So he's got a cool little ecosystem there of like helping each other out. We call it the family syndication group. We really act like a family together. We all find deals, we all source deals together, and then we raise money on deals together. You don't have to, right? It's not forced. Nothing is forced in
Mm-hmm.
the program. It's more, just all of us getting together and trying to get deals done because we're better together.
Yeah. Yeah, for sure. So there's, I'll probably dive into that more when he comes on the show, but there's tons we could talk about about this because I'm very interested in it as well. Um, but let's dive into like your first deal. Well, first, how many units do you have now?
Just shy of 700.
Just 700. Okay. So let's go into your first deal that you found. Um, how did that process kind of work? You got your mentorship program, you were learning, you educated yourself first, which is like a huge part of it, right? You can't just go out, start trying to buy 100 or 200
Right.
unit property and not know what cap rate is or IRR or
Yeah.
any of
Yeah.
these terms. You know what I mean? Like you have to
Yeah.
know
Yeah.
some stuff. So you did that, you got your
Yeah.
mentor. Um, how did you identify the location where you're going to buy your property? And then what was the process from there?
Yeah. So, and this is getting into a lot of like my business philosophy, but I'm actually not in the business of sourcing deals so much. I do sometimes, like I want to look for my own deals, but primarily the way I'm adding value these days is playing a couple different puzzle pieces in the whole pie. Mainly, I'm able to raise capital very well and able to like put down earnest money. I'm able to work on due diligence and closing and really just all the other puzzle pieces. Our group has such good deal flow like this. And again, I don't want to plug the group too much, but we have so many deals coming in that there's really no need for someone like myself to be looking for deals on a full-time, full-scale basis. So, I've got a couple markets that I'm looking in pretty regularly, but mainly what I focus on is just trying to raise capital and be a really good steward of investor money. Um, so we can talk about the first deal that I did, and that was actually in Memphis. And a lot of people really don't like Memphis for various reasons, and some of them are totally legitimate. But some of the areas that we're focusing on is really in the path of progress, and we've had really good success there. So this first deal was found by someone in the group, and it was 384 units in Memphis, and it was a good value add property. There was it's very clear value add, and so I came in, I helped raise a little bit of capital for it, and so far it's going really well. I've done some investor relations with it. I've wrote it. I've done lots of stuff to it, but right now it's starting to actually generate cash flow for us, investor returns, and so it's putting off cash flow, which is all you can ask for.
Yeah, for sure. So how is that? How many general partners is there in that deal? Is it just you or there's a couple of you guys?
No, there's a couple. You know, most property or most deals probably have like 3 to 5, I would imagine, because like you were saying earlier, you have to have net worth and liquidity for some of these loan products that we go after. So you have to have net worth equal to the loan amount, which this was a $23 million deal. I don't have that net worth. So we had to partner with
Not
someone
yet.
who did have that.
Yeah.
Liquidity, meaning you got to have somewhere around 10% of the purchase price liquid. And so again, we partner with someone with just cash in the bank, and they get a portion of the partnership for that. And of course, people who found the deal, who raised money on the deal, who want to asset manage the deal. And so you cut that pie up a little bit. But yeah, 3 to 5 people is probably pretty average on most deals.
Okay. And then how did you structure this deal? Was it a 70-30 split with the GPs and LPs, or
Yep,
was it different?
exactly. Nope,
70-30?
70/30 split. And this was actually on a bridge loan. So if you're not familiar with a bridge loan, essentially there are a couple different products for large multifamily. Um, Essentially, one of them is long-term, low fixed rate debt. The other, or I guess I should say, longer term loans. And then there's some shorter term loans. A bridge loan is a shorter term loan. And the reason we chose a bridge loan is because they give you, well, there's a couple reasons, but on this project, they give you construction funds. You can finance construction funds. You get interest only for a period of time. It's a little bit higher of an interest rate, which you know is good and bad, right? If you're confident you can raise that money or that value quickly, it's really not a big deal, and then you can refinance into that long-term low fixed rate debt.
Mm-hmm. Yeah, no, definitely. Um, it's kind of just like a rehab loan for the smaller,
Exactly. Fix and
s-
flip loan, private money loan, or hard money loan,
just
whatever
for a
you want to
giant
call it.
property. So did you
Not
end up? Go ahead.
our interest rate on that is like, I think it's 5.8. So we're not even close to like hard money loan rates. But when you're talking our long-term low fixed rate debt, we closed a deal earlier in the summer. Me and another partner, our interest rate on that was 3.95, I think. So they
Oh,
get pretty low.
yeah, that's awesome. So is that a like a institutional debt? That's like a long-term 30-year
Yeah.
fixed kind of Fannie
It
Mae.
it it's a Fannie Mae loan, and it's actually a 12-year term, but it's amortized over 30 years.
Okay.
And we got, I think, 5 years of interest only payments on that, which
Oh,
is insane. I
so it
mean,
must have already been like a stabilized and operating building.
yeah, yeah, our occupancy was over 90%, so we qualified for it day one. But what's really cool is going back to our small multifamily versus large multifamily is these loan products just don't exist for small under $1 million loans.
Mm-hmm.
If you're looking at, a 20 unit building and it's, 800 grand or 500 grand, you're looking at bank financing, commercial banks, and those terms are garbage. I mean,
Mm-hmm.
just to speak clearly, like commercial loans are like somewhere around probably 5-6% amortized over 20 years, probably.
Mm-hmm. I know it's
Recourse.
hard to make the numbers work when your loan is taking up all your
Yeah.
cash flow.
Yeah. It's terrible. So, I mean, that's the whole benefit of multifamily, right? You get to take advantage of these housing and urban development loans that are subsidized essentially by the government.
Yeah. Okay, cool. So you're in the group, you're learning all your stuff. Somebody brings you a deal and says, "Hey, it's in Memphis, 324 units." You say, "Hey, this is something I like to do." Do you partner with that person that brought it, or is another partner in the deal? A couple other partners in the group,
Yep.
I mean.
Yep.
Okay.
Patrick found the deal. He brought it to the group, and I was happy to be a part of it.
Okay. So then, did you fly out there to the property and check it out, and before the
Yeah.
letter
So
of intent?
when I got involved in this deal, it had already had due diligence done, and it was already completed past that point. So there was really no need for me to go out there. But on all the other properties, absolutely, I'm flying down there. I'm doing due diligence, taking pictures, meeting with property managers, stuff like that.
Okay. And then when you're coming into a new market, how do you kind of determine, because if you're going to go to a new market and you buy a single family or a fourplex or something, you can just interview a couple small contractors, right? But
Hmm.
when you're going and you're going to buy a 300 unit or whatever, a 100 unit property, I would assume that you're not just going to the local contractor that builds a
Yeah.
couple houses a year. They can't like handle a whole project and property manage the whole thing and
Yeah.
do this renovation. So how do you find these operators in each
Yeah.
market?
That's a good question. I don't know what everybody else does, but what
Hmm.
we do is we just lean really heavily on our property management company. The folks that are managing this property, they have a phenomenal reputation. They've got over 10,000 units under management, I believe. And so they have just crews of people that they know and they trust. And so we don't really care who they hire as long as the quality is good and the tenants are happy.
Hmm.
So we really leave that up to them. But I know they keep a full-time crew fully employed, because we're churning units, right?
Mm-hmm.
384 units on that are going to be turned. Well, not exactly. I don't know if we're doing all of them, but that's probably around 6.5 to 6.7 units per month on average.
Wow.
That keeps a crew pretty busy.
Yeah, that's a lot to do. So obviously it's on-site management and maintenance guys and a whole staff of people and everything.
Yep, exactly.
Okay, cool. Right on. So with something like this, if somebody was going to, they have this is kind of, you don't have to answer this question if you don't want to, but, when you have a couple general partners in there, is it really making you guys enough money in the now to like, that it's a substantial amount of cash flow, or is it kind of like a long-term play to where you're waiting till the disposition of the property to get your big chunk change?
Yeah, that's a hard part of syndication. And, like we were talking about earlier, is we see a ton of people jumping into this, but I also see a ton of people jumping out of it
Mm-hmm.
because it really is a get rich slow game. You know, Syndicators on the general partner side, we do have usually what's called acquisition fees, which is it's essentially a fee, usually 1 to 2% of the purchase price, and that gets paid up front when we close. And so that's really the big chunk of change that we're able to at least keep the lights on, right?
Mm-hmm.
Now we do have cash flow coming in, but all of our deals are 8% preferred returns usually. At a minimum, there is some sort of preferred return, meaning the first 8% or whatever percent that the property generates goes straight to the investors. We don't share in that at all. So anything above that, we get a little bit of cash flow. It's usually split 70-30. So you're not talking a lot of cash flow.
Yeah.
And so you get paid in proportion to the amount of problems that you're solving in the deal, right? So if you bring in earnest money, you get a portion of that. You raise money, you get a portion of that. You do sourcing and helping close and all these things that can increase your percentage of the deal. But in general, the big pay, like you said, comes on the back end, or once the investors get their principal back. And at least in our deal, every deal is different, right? But in our deals, when they get their principal back, we split everything 70-30. So that pref goes away. So that's when cash flow starts to come back.
Yeah, for sure. So yeah, it's kind of a different aspect to look at it. Like probably the reason why you like it's more like a business, to where if you're buying a small single family or small apartment complex you're doing on your own, you're buying it for like the cash flow, and then you're getting investment income. I don't know if
Yeah.
I'm explaining this right. But then when you go to this big syndication model, you're getting money, you're earning the money by doing work on the project. Like you get a fee for setting up the project and closing on the deal, and then you get paid a little bit of cash flow, but sometimes there's management fees and different levels of fee structures for if they raise the equity or raise the value of the property to a certain extent or whatever, and then disposition fees when you go and sell it. So it's like it's more of a job. It's definitely more of a job than just a long-term thing. I don't know if I explained that.
Yeah, I work a ton of hours, and I think the point you're trying to make is like you could have a ton more, frankly, if you wanted to go out and buy like a 20-unit apartment building by yourself, if you have the ability to do that, you're going to make more money, right? The value of syndication is you're able to spread that risk over more units. You're able to invest in a much more professional asset. It's professionally run. You get to economies of scale. You get to leverage large management companies, all those things you can't do. So yeah, you might make a little more money, but the safe route is definitely bigger asset classes. And that's why family offices love this. Sophisticated investors love this. Wall Street loves this. Everybody wants to be involved in multifamily. So,
and down the
everybody
road,
can't be run.
Yeah, no, that's true. And down the road, I would assume that, in the beginning, like you said, you're not making a ton of money on it. But you're getting the experience and you're getting into a group of people that are in this field. And so you get your name known, you get trusted in the industry. Down the road, you're going to have a lot of money at some point. So then then you start buying your own deals of this size, and then it really starts flowing. It's just like a
Yeah,
magnified snowball.
they compound on each other, especially because you can roll acquisition fees into passive investments. Like you can roll it into the LP side, the limited partner side. You can leverage your acquisition fee to then go on the next deal, put down earnest money, and get more, GP shares that way. You can, there's any number of ways you can really start to, snowball these deals into more and more money. But it's really a slow play. This is not something you're going to be able to quit your job tomorrow doing. There's some people in the group that quit their job within a year, but it didn't work out for me, but I already quit my job, so it's no big deal.
Yeah, no, that's true. Cool. Right on. So, I guess the next question everybody always asks is, where the economy is, and that sort of thing is, what do you guys do to kind of, buffer for that or plan for the next
Yes.
phase, the next roller coaster,
I
if
love
there
this
is
question.
one?
I love this question. So, you know, I don't mean to like plug my own self, but I have a podcast too called Fear Free Passive Investing, where we focus just on commercial passive investing. And that is by far and away the number one question I get from potential passive investors is like, are we ready to like go over the cliff, right? Is there another recession coming or whatever?
Yeah.
And to be honest, I don't see it.
Yeah.
It has to happen sometime, right? Like we all say this, it just has to happen. But um, we've been hearing that since I was a lobbyist. So like
I know.
2015, I
Yeah.
remember the investors around me saying like okay, it's coming any day now, and it just hasn't. And
Yeah.
a couple of reasons why I think that is. Number one, um, so, and this is probably getting a little too, you know, economics
No,
for your
do it.
podcast if you don't want to,
It's
but
fine.
um, basically foreign bond markets are essentially negative in most cases. So what that means is, if you invest in a bond in say Switzerland or Germany, well, Germany I think has a little bit of a positive yield, but other countries have negative yields on their money. So you buy a bond, you're essentially paying the government to let them borrow your money.
Which
So
is crazy.
it's crazy. And so and it's not as crazy as it sounds. Like you can still make money on, buying bonds if they go lower, right? You can sell your share. But so all that to say that there are tons of foreign investors looking for any sort of positive yield in the world, right? They can put their money anywhere. So you leverage that, and then you look at our deals, which are yielding somewhere around 10% cash on cash return, somewhere around there. Of course they're going to put our money there. Like foreign money is just pouring into the US's commercial real estate market. And so
Mhm.
all that means is that cap rates are continuing to go lower. The interest rate environment is essentially as low as it possibly could go. I don't see how it can go lower and still maintain like the the veil of being not tied to whatever Donald Trump says. So
Yeah.
like the interest rate environment is just crazy low. And so when you have really low debt, or debt to income ratios are high, and the foreign market is just flooding our market with money.
Mm-hmm.
And then you have all this equity built up in the market from people that like all their properties are worth more. So they're selling and then they're 1031 and exchanging and then they're buying more property. And all of this is just like tightening up the market a ton. And so there
Yeah.
was a little bit of a slowdown early last year, just when interest rates were higher. And so sellers had to make a little bit more concessions. And we thought that maybe was that the start of it. But man, like cap rates are continuing to compress and we're still doing deals. So the way we hedge against that, and this is really getting to the point of what you were asking, I think, is um, there just like in single family, just like in if you're buying a house, you want cash flow, right? You don't want to count on appreciation. It's the same thing in multifamily. So when we calculate our internal rate of return or our IRR, I like to have a really good mix of cash flow in there. So IRR essentially is the time value of your return. So returns come at different times during the hold period. And so you can have a really high IRR with no cash flow. And essentially that means like you're just banking on adding that enough value to appreciate the property, right? You're forcing that appreciation. Or you can have an IRR where it's like half appreciation, half cash flow. We call that a hybrid, and that's what I focus on. So even if the market takes a dump and our values are dropped significantly, our deals are still cash flowing. So, and if our 5-year window to sell comes and goes and our property just isn't worth that, we'll just hold on to it, right? We've got the 12-year debt, which is huge.
And you let your investors know that, obviously, going in, that, our goal is 5 years, but potentially, and we could end up holding it for longer.
Absolutely. And that's such an important point to make. Like, I have a pretty frank conversation with new investors, and I say, look, can you afford to lose this money? Because, if a sponsor is saying, oh, you'll never lose your money, you should run, right?
Yeah.
And also, like, you better plan on not having access to this money for a while, right? We say, on this one, it's a 6-year hold. It might be 10 years, right? Like, we're not going to take a loss on the property just because you want your money back, right?
Mm-hmm.
So we just have that frank conversation, and most people are pretty receptive of that.
Yeah, no, definitely. I do know some sponsors or some syndicators, they have it to where if you do want your money back, if you can find somebody that can replace your money and kind of take your spot in it, then they'll, exchange it. But
we do that too. But like I said,
that'd be a pain in the ass.
Well, it isn't. It isn't. Like, it's a catch-22, right? It's nice to be able to say that to an investor.
Yeah.
But if they need their money back, they still need to find someone to buy their shares, right?
Mm-hmm.
If the property's doing really well, that's going to be no problem. If the property's not doing well and you just want to cash out and go, you probably won't be able to find an investor. So that's why I say just plan on, not seeing that money for a couple of years.
Mm-hmm. No, definitely. Yeah. And kind of my take on the economy is where it's at is, maybe there's going to be something happen, but most likely, is it going to be in the real estate realm again?
Yeah.
I mean, I don't really think so, because each recession or big economic crisis we've had, right, they kind of go to different things, from like the 90s to 2000s to 2008, they were all different industries. So, like you said, as long as you're buying for cash flow and your properties, who cares if your property is worth $1 million today and then it's worth $0 tomorrow, as long as in the meantime you don't sell it and it's making cash flow. Like, I don't really care how much it's worth on paper, as long as it's making me money.
That's the same thing with stocks, right? You only make money, or you only lose money when you sell, right?
Yeah.
It's the same process. And just one last little point, like, even if it is a real estate recession, some sort of correction based on real estate is so broad. I'm not even sure there is a quote real estate market. Are you talking like high value luxury residentials in West Coast markets? Are you talking, C-class value add multifamily in the Southeast? Like, could it be flips? Could it be wholesaling games? Like, all these little aspects of real estate investing, there's people who made a ton of money during the last correction. And there's people that lost a ton of money. So,
yeah,
well,
and the last one was mainly based on bad loans, right? Bad loans that were being made by, I mean, there's a whole bunch more to it. Yeah, but mainly, I guess it comes down to a huge sector of the residential loan market that were given to poor candidates. Well, they've like changed all those rules, right? So it's much more difficult now to get a loan than it was in 2005, 2006.
There's still, it's funny you say that. There's still, like, I hear radio ads here in Colorado advertising essentially a zero down mortgage, where you can do the FHA, first time home buyer, for like 3.5% or whatever.
Mm-hmm.
That 3.5% will be kicked in by our state government, or like a hybrid thing.
Yeah.
So we could be in the same problem here in Colorado, but
yeah, and maybe that'll be region by region, like market dependent. So cool. Okay, well, where are you guys going from here? Are you going to continue obviously building your syndication
Yeah.
company, Bannock Capital, and you're just gonna have 10,000 units in a couple years, or what's the plan?
I really love this. Like, honestly, I've done a lot of different real estate investing, like
Mhm.
a lot of different little things here and there. I've never loved anything as much as I love this. Like, I could see myself doing this for decades to come. And so there's no reason for me to slow down. I love my job. I love the way I have my life structured right now. So I'm just going to continue status quo. I'm happy.
Yeah, cool. And this is all you do full time, right?
Yeah, and take care of my two little boys.
Oh yeah.
When they're not in school, I'm running around with them. But my wife works full time too, so um, we got a busy household. But we all work from home, so it's cramped, but it's fun.
Oh yeah, that's cool. That's awesome. Well, right on. Well, Lucas, I appreciate that. We're gonna move kind of
Yeah.
next little round here.
Yep.
What's your favorite resource for learning about real estate? Is it mentorships, books, podcasts? What is it?
I love learning from my peers, like the people in this space, whether it's good or bad, right? Like I learned a lot of things not to do from a lot of people.
Hmm.
So my favorite overall is learning from people, and then going to live events, listening to podcasts. I've been really into like learning from YouTube lately and marketing strategies and stuff. So that's been fun. And then obviously, the mentors I have in my life.
Yeah, for sure, definitely. So pretty much boils down to networking. Networking's the
Absolutely.
key.
That's everything.
Is everything, right? Okay, so what about a favorite app or a piece of technology that you use that makes life easier?
Yeah. So, like I said, I've been, really leveraging YouTube lately. I'm really trying to up the content there. I love the idea of helping passive investors, like educating them with content. So, YouTube for sure. And then also Notability. Like, I don't know if you've ever used that before, but
Uh-uh.
it's an iPad app, and it's essentially a note taking app slash PDF editing app slash just a native notes app, and it cloud syncs to from my iPad to my desktop to my phone. So it's really cool to just throw something in there and then on the go grab it, pull it up on my phone. So
Okay, cool. Right on. Mindset tip. How do you kind of stay motivated and chugging along when the real estate days get tough?
You know, I don't have a good answer for this one. I was struggling for a while. Like, I'm not motivated. And my thing is, I love what I do so much that I never feel the need to, like, pump myself up and feel motivated and all this stuff. I just love what I do. So I love grinding things out. Like, I'm right after we hang up this call, I got another 2 deals that I got to analyze tonight. So that's going to be a late night, but I'm really looking forward to it. So mindset would be just find something that you love so much that you don't ever need to be motivated.
For sure. So it's not that you're not motivated. You just love what you do. So it keeps you motivated.
My
Maybe
motivation is beating out everybody else. So we'll say that.
Okay.
I
Well,
want to
when
be
I start
better than
doing big
everyone.
deals, we'll have to maybe team up then. That way we don't have to beat each other out.
Yeah, that's right. I love that.
Yeah. Okay. Right on. So where can people find out more about you, your company, and anything else you want to say before we get off here?
Yeah. So, if any of your listeners are interested in passive investing at all, I put together like a case study, and I'm kind of proud of it. It goes from $0 a year in passive income to over $40,000 a year in passive income in less than 5 years, and it's a case study of how you can spend, less than 3 hours on this on average a month managing these passive deals, but still getting massive cash flow. So if you want that, just head on over to bannockcapital.com, BANNOCK capital.com, or just shoot me an email, lucas@bannockcapital.com.
Okay, cool. And what's your podcast called? Don't forget to plug that. I'm all about
Oh, yeah,
plugging
yeah.
everything. Oh yeah. Do it.
So yeah, it's called Fear-Free Passive Investing. And, if you're looking to flip houses, it's not for you, right? It focuses on, our audience leverages education for people who don't have time to invest in real estate or don't have the expertise, or, they don't really have the motivation. They just have some money that they know they should be investing in real estate. And so we give them tips and tricks and interview people who have been in their shoes before. And we have a lot of fun. So.
Cool. Right on. Well, Lucas, I appreciate you being here. Hopefully some people gain some insight more into the passive investing side, the syndication model.
Yeah.
I hope people go to your podcast and check it out. Get his case study at bannockcapital.com or Lucas at Bannock Capital.
Yeah.
And
Whatever.
yeah, man. So I appreciate you being here. Thanks again. And you have a good evening.
Yeah, Justin, I appreciate it, man. Looking forward to having you on my podcast now.
Right on. Let's do it.
All right.
All right,
Thanks,
man. See ya.